This way of finding the daily bias is recommended by ICT, and it's 100% mechanical, and any beginner with no knowledge of fair value gaps, liquidity, or drawing liquidity, you can still apply this method and get the daily bias very easy. I recently posted 2 ways of finding the daily bias. One is using the daily candle, and the other one is using liquidity and fair value gaps. Both of those ways, I would say the fair value gap and liquidity is more subjective than the daily candle. The daily candle, I would say it's 50% mechanical, but this specific way recommended by ICT himself is 100% mechanical. So it's different than the other ones that I posted about. If anyone needs one-on-one mentorship, check out the description. This is Mulham, and let's get into the video. Now, the first thing that we're going to do, and in order to find the daily bias, we're going to switch to the daily time frame. That's the first step. And this works on any market. So, for example, we're taking a look at British pound and the US dollar, GBP USD. This is the first step. We're going to be using the daily time frame. And we're going to go to the indicators. And what we're going to look for is EMA, so moving average exponential. And this is, as I said, recommended by ICT himself. And it's a very easy way to find the daily bias. I know a lot of people don't like the use of indicators, but some of those indicators are really helpful. For example, using the moving average to find the daily bias and using the specific ICT's way, it's going to be helpful, especially if you have no knowledge of fair value gaps and drawn liquidity. We're going to be adding 2 moving averages, and we're going to come to the settings. The first one is going to be a period of 9, and then let's say we're going to be doing a red color, for example, and I want to make it more thick. That's the first one. Now we come to the next one, and it's going to be 18, and then let's put it at a blue. So blue, and then thickness a little bit up. Now, what do we have? 2 moving averages. The first one is much faster. This is the 9 EMA, and the slower one is the 18. 2 on the daily time frame. Basically, we have a daily bias here. So the rules are, and make sure to take notes now, when we have the red moving average, which is the 9 EMA, below the 18 moving average, we are in a bearish market, we are in a bearish framework, or we are in a sell model, and price will continue to the lower side. So our daily bias would be bearish. On the other hand, and it's totally the opposite, when the 9 EMA is above the 18 EMA, we are in a bullish framework, we are in a buy model, we are being bullish. If we start from here, for example, we can see that the 9 EMA, the red one, is below the blue one. And we can see how price was literally going down. There are some days where price is going to go up, and it's totally normal to have losing days. But a lot of the time, you're going to see this working like a magic. For example, you see how price was going up here, coming lower, and as soon as there was, the moving average, the 9-1 below the 18-1, we can see that price was literally going down, and any fair value gap that is bearish was holding, and price was pushed to the downside. So your bias for this period of time is to go to the lower side. And you can see how price was literally going down, breaking lows, and it was going lower and lower. Anytime you go to the lower time frame on those candles, you're going to see that the high probability setups are going to be short setups, and they're going to be on the lower time frame, aligning with the higher time frame bias, which is in this case 9 EMA below the 18-1. It means we are in a bearish framework. It's 100% mechanical on any day. If it's below, then we are bearish. If it's above, then we are bullish. That's it. It's not subjective at all. And it's really easy to follow, especially for the people who are beginners and then they're just starting to trade SMC or ICT. They're really struggling to find their bias using the fair value gaps and the drawn liquidity and the liquidity. So this is a very easy way to follow. Today's video is sponsored by Hanko Trade, one of the best brokers in the business with spread as low as 0, low commission, and you can trade all markets, including forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. On the previous 2 weeks, looking at GU, what do we see here? So the 9 EMA was above the 18, and we can see how price was really finding support from any fair value gap. So you see this is a fair value gap here that we could have used, and this fair value gap is a bullish one, and price was pushing the price higher. And simply here, another fair value gap that was created. And a lot of people sometimes when they have a bearish fair value gap on the other side, they're going to be using the fair value gap. It could give some reaction from there, but the bias is literally going to the upside, and we can see any fair value gap is going up. And sometimes you see even here, it was not really that high probability to find a buy setup here, but even buy setups, this order block right here was also holding and price was going up. So the same for the next day, we're also looking for longs. Why? Because the 90 EMA is still above the 18. Now, showing you some examples how we can relate the higher time frame to the lower time frame, or the bias to the lower time frame entry. They're not going to be exact entries, but show you how to look at the lower time frame, because otherwise we need to do a whole video about daily bias and lower time frame. But this is a video just to show you this way, but I'll add some examples here. So basically, we can simply see that so far the 90 EMA is above the 18. Now, if you go to the lower time frame, so for example, 15 minutes, and disable all of the indicators, the EMAs, and we know that for the previous days, we've been bullish. So I think from somewhere in here all the way to the current price action, we've been bullish. One way to look at this is look at the Asian low and Asian high. When we are in a bullish scenario, we really only want to see Asian low to be taken, for example, or we'd be entering when there is a sweep of a low and then change of character. So for example, you see how we had a sweep of this external low and then price going up. So we could have found an entry here. And why is this more valid than, for example, taking this high? Why? Because the daily bias using the EMAs method is telling us to go up. So you see, this one is holding more than this one. Now, if we go more to the right, what we can see here is this is my Asian session right here. And we can see that the Asian, this low, the Asian low, but there is this low that is, I would say it's part of the Asian session. Why? Because it's a fractal low. This is not a fractal low. You see how price is sweeping this low, then started to go up. That's more valid than price taking the high of the Asian session. So you see, high of Asian session taken, price expanding to the upside. The low of the Asian session taken, what happened? Sweep. So that's a big difference here. Now, if we go here, another example, taking a look at this New York high, for example. New York high taken, still not respected, and price going up, then coming lower and then going up. But this low of the New York taken on Tokyo or taken on the Asian session, what happened? Price going up. So this very simple way, it's going to filter a lot of the bad trades, and it's going to only leave you with the high quality trades. Now, for sure, there's some times where the high would be taken and then there would be a sweep, but it's not as high probability as the long position. Why? Because we are in a bullish market. We are in a bullish framework. Now, again, taking a look at this, what do we see here? Asian low taken, price going up. Now, right here, it did not last much because at the end, price wants to retrace. But as we can see, again, we have this external range taken, then that's a high probability setup. Why? Because this low is taken and price coming back into discount. And are we in a bullish or bearish framework? We are actually in a bullish framework. Why? Because the 9 EMA is above the 18. So now price going up, and you see respecting fair value gaps going up, and we see again Asian low is taken, not the fractal low, but actually the low is taken with a wick and then going up, and the same thing goes here. So if we see what happened is again the low of the Asian session and also this low that has the fair value gap below taken, then price going up. Now right here you see the high of the Asian session is taken and then price going lower. It also will happen that every time price breaking the highs, it's going to be a breaker structure. No, sometimes it would be a sweep, even though you are in a bullish framework. So not every high is going to be a breaker structure. And we can see this is the framework here. Taking lows in a bullish framework, that's a higher probability than just random highs and lows. Very easy way. I would like you to follow this, give it a try and see how it goes. Much, much more mechanical than the fair value gap and drawing liquidity. The fair value gap and drawing liquidity, it could tell you what the direction is or where price is heading to. But this is a very mechanical way to find the daily bias every day, even when you don't have a clear drawing liquidity. But it's always better to align this with a clear drawing liquidity. Hopefully you guys like this gem that I shared today, and more to come. As always, please drop your videos ideas below in the comment. Like this video, share it to your friends who might need this, and I'll see you in the next video.